you'll be able to rewatch your presentation and your coaches and colleagues.
Sounds good.
I just have a question.
Yes.
When you said you'll be showing like 10 minutes, 5 minutes left, is it from the 20 minutes or from the 15 minutes?
So you have 20 minutes, and then at the 10-minute mark, I'll send a message in the chat of the Zoom 10 minutes, and then 5 minutes and 3 minutes like remaining to your presentation. Does that clarify? And you also have a cuckoo link if you want to see the countdown.
Okay.
Just want to make sure that everyone sees the screen.
Yes, we do.
Perfect. Perfect. So when may I begin? Am I good to go?
Yes.
Yeah, perfect.
Yes,
thank you.
whenever you're ready.
Yeah, thank you so much. Okay. Good morning, Fast Speed Inc. executives. Myself, Daniel, Justin, and Sonia will be showing our fiscal year 2020 tax implications. So first, a little agenda of what we'll be discussing today. So we'll start off with our taxable income and how much of additions and deductions needed, and then our overall taxes payable. And then finally, there are two subject areas which required more information, which are the employee incentives and the building sale. So just a quick summary.
So first of all, for the quick summary, the taxable income is 0, and so therefore the taxes payable is also 0.
For the employee incentives, we just kind of wanted to go through the short and long-term disability insurance, since that seemed to be your biggest concern. And we decided that that 100% of the contribution should be made by employees.
And then finally, for the sale of the building, we would recommend you sell it.
So first of all, to calculate taxable income, we started from the pre-tax accounting income of 4.6 million. And first we added the accounting amortization of 233,000, because for tax purposes, it's the capital cost allowance that is required to be deducted, and the capital cost allowance we will talk more later on. Secondly, we added back the bad debt provision, and we instead created a reserve for doubtful accounts, which is the equivalent of the financial accounting bad debt. And the bad debt of 360,000 is deducted in the current year and will be added back next year. And then we also added back the research and development tax credits because they haven't been cashed out this year. So we need to include them in the taxable income. And instead, they will be deducted from taxes payable once they're received later on. And we have also added back the provisions for the litigation and warranty because they cannot be deducted since they have not occurred yet. So we have added back 324,000. And also we have added back the $50,000 of fees for the loan project financing. And these fees include bank fees and the legal fees. And the CRA mandates that the fees need to be amortized over the life of 5 years, so 20% per year. So we have added back the amortization of 12,500 and the legal fees of 15,000. And the total fees of 50,000 will be amortized over 5 years, so 10,000 per year.
So the next subject area is the overall working conditions, since we all know that it is a great time working here. So you guys give us special benefits such as the gift baskets, the luxury retreats, and the overall corporate box. So the first subject area is the gift baskets. So given the COVID-19 circumstances currently, we deemed that this would be a social event since we weren't able to have the typical Christmas party that we normally do. So this, as a replacement, we still deem this as a social event. And the CRA deems that the per person limit is $150 for it to be deductible. Unfortunately, based off our calculations, it ended up being $193 per employee. So unfortunately, it is not deductible. So one of the tax strategies in the future, or even now, is to estimate better. So for instance, the 75% which we estimated, perhaps we could have counted the actual amount of people who attended. And if this was higher, then the per person might have been lower, under the $150. But unfortunately, given the information we have right now, it is $193 per person, which means that we have to add the gift basket total of $325,000. Next is the luxury retreat, and CRA mandates that this has to be specifically for business related activities. Unfortunately, we found that solidifying the product knowledge, the CRA might not deem this as business focused enough, especially since we are going off to a luxurious place just for this. So we have decided to add back the $88,000 in this front. And then finally, the corporate box. So only 50% of the entertainment, whether it be the meals and entertainment costs, can be deducted. And since this is for a sporting event and it's to help find customers and to help employees, it can be deducted, but only 50% of it. So only $34,500. And since we assumed that the rent was already paid for these sporting events, we took the full amount. So the final two additions to taxable income are the 2019 bonus that was supposed to be paid to a former executive, but unfortunately, since he didn't stay until February 1st, the bonus was not redeemed. So in 2019, since it was within 180 days from the end of December 31st, 2019, we assumed that the bonus was already deducted in 2019. So we need to further add it back this year to make sure that our taxes are in line. And finally, we incurred an interest penalty of $23,000. And unfortunately, the CRA does not allow us to deduct any penalties. So we need to add this back. In total, all of these additions that we just mentioned, it totaled up to $1,440,000, which we need to add back to taxable income. And now for the deductions to taxable income, the biggest deduction is the CCA, especially this year since we decided to vamp up our operations and open up new manufacturing equipment, open up new product lines. So this is a very interesting aspect of taxes this year. So we decided to focus on three main ones, the Class 8, 50, and 53. So for Class 8, we had additions of $651,000 in office equipment and furniture. And since the new, from 2018, ACCI rules apply, that made the total Class 8 CCA from what we had before and from what we added this year was $510,000. Next is the Class 50. We decided to put it into Class 50 since it was related to software and implication. And this also, the ASCII rules still apply, which means that the total Class 50 CCA was $914,000. And finally, for Class 53, this was a major implication since we purchased over $3 million worth of manufacturing equipment. And because of the ASCII rules and the new implications, it meant that we could deduct it fully. And this, along with the previous Class 53, the total CCA for these two is over $7 million. And this is more than the total of our additions and our pre-tax, our accounting income for, our accounting income pre-tax, exactly. So the total CCA permitted is the summation of those two, which is almost over $6 million. And we wanted to make sure this brought us down to an income of zero. And we must remember that CCA, it's an elective type of classification. So we can still, once our ending UCC balance, next year we can still deduct it so that we can finally get to a smaller taxable income in future years.
So as Daniel mentioned, we deducted CCA until the taxable income reached zero because the CCA cannot create a loss for the company. So the tax expense, to calculate the tax expense, we did the pre-tax accounting income of 4.6 million times the statutory rate of 26.5%. And we have also added the current income tax expense and subtracted the deferred income tax expense to get to 1.3 million. And this is how much tax that they need to record on their financial statements. But for taxes payable, it's zero because there is no taxable income, which creates a deferred tax liability of 1.3 million because the taxes payable is higher than because the tax expense is higher than the tax payable.
So I'm going to go through the additional questions you guys had about, the insurance plans and like some questions from employees and then the building situation you guys have going on. So for health and life insurance, employee premiums are a tax deduction and employer premiums are a tax benefit to employees, but a tax deduction to the company. So basically it's depending on whatever you guys want to do about the deduction, like the premiums, if you want to pay them and have them as a tax deduction for yourself, or if you want the employees to pay them so they can get a tax deduction, it's really up to you. We would probably recommend paying them as the employer since you guys want to give your employees the best situation possible. While these are a tax benefit, the employees you can still make them pay 50%. So then it ends up being a zero benefit because the benefit can be lowered by any premiums that the employee pays themselves. For short and long-term disability, it's a bit more complicated, but neither are taxable benefits when paid by the employer when contributions are made, is what I'm trying to say. But any benefits that you receive from one of these plans, as in like taking it out, getting the money if you're on short-term or long-term disability, will be taxed upon receipt if the contributions were paid by the employer. So we would recommend probably having the employees make these contributions just because if you are on short or long-term disability, it's likely you need the money more then than when you're working and making money. So it'd be nice to have that not be taxable for employees at the time that they need it most, really. And then finally, the stock options that you guys are providing to the executives will require a stock option benefit on their taxable income, on their taxable tax return, their personal tax return. And the employees will also be required to include a stock option benefit in their tax return for the offer you're giving them for buying basically essentially 3 shares for the price of 2, and then redeeming them in 5 years. And then the additional questions from specific employees. So there was one asking about the CERB, and this year is very different. Obviously, we have a couple of different tax implications with different things, such as the CERB. Any amount that you receive from the CERB is taxed as normal income. That being said, we don't know how much this employee makes. We don't know exactly how much taxes he will need to pay, but it's assumed probably not too much. We probably won't be in a very high tax bracket since he is a part-time employee after all. And then the tax receipt for a tax treatment for the government receipt for that employee who worked 4 days a week and was given a government grant for the additional 5th day. This amount will be taxed as normal income, just like the CERB. These are hard times, but I think that that is considered income under CRA's eyes. Finally, the home office deduction. So in 2020, there's been obviously different situations. People need to work from home, requiring a lot more home offices for people who normally don't have them. So the assumption we're making here is that the question was being asked by an employee who doesn't normally require a home office, and as a result, obviously does not normally take the home office deduction. So in 2020, for all employees, there's a $2 per day flat rate deduction that can be taken if you're working at home due to the COVID pandemic. The maximum claimable is $400. That means 200 working days, and you need to have worked at least 4 weeks at home consecutively to be able to qualify for this deduction. It seems as though that may be the case because of how long lockdown is and how frequently you need to be working at home, but just need to make sure that they reach those criteria. And then for the building sale, So you have 4 options really, 3 big ones mainly though. So the South Central, you can sell your South Central building, which is the newest building that you've acquired. This would result in a capital gain of $1,200,000, which 600,000 will be taxable for the land, and a capital loss of $225,000 for the building, which will not be allowed because buildings are considered depreciable assets, so you can't take capital loss on that. There will also be no recapture or terminal losses because CCA has not yet been claimed on the building, so there won't be any recapture or terminal losses since there's no CCA account actually set up for this one. With respect to the rental option for the newest building, any amount that you receive will be included in taxable income as rental income for every year that you receive it. So whatever that amount may be, as said, obviously you assume you can't make the full $35,000 for renting out the whole building. But maybe, if it's $30,000, then you would receive $30,000 that'd be included in your taxable income every single year that you make it. And then finally, the sale of the Brossard building. So this would reach, if you sell this building, you'll have a capital gain of $200,000, of which $100,000 will be taxable due to the land, and a capital loss of $1.8 million for the building, which will again not be allowable because of, for deduction because the building is depreciable. There will also be a terminal loss in this case that will be able to be deducted from your taxable income of $456,898. And that's arising from closing out the Class 1 CCA account that this building has been in since you've been using it. You could also consider renting this building out, but I don't really think that's the best idea just because we don't know how much you'd be making on that. You'd probably make more for renting out the South Central building. If you're going to rent one out and keep them both, you may as well rent out the South Central building. So our conclusion is to sell the Brossard building since it has less tax implications than the South Central building. You guys don't really need 2 buildings. We're not in the business of renting buildings out here. We're really not, that's not our main priority. And it is closer to the clients than the Brossard building is. So it just seems beneficial all in all to use the Brossard building, to use the South Central building and sell the Brossard building.
So finally, for conclusion, there's no taxable income, therefore no taxes payable.
The employee incentives, you should have 100% employee contributions for the short and long-term disability insurance.
And finally, for the sale of building, we recommended to sell the Brossard building instead of the South Central building. So thank you very much. And now we open the floor to any questions that you may have had.
Thank you very much, Team C. Let me just stop the recording and then we can proceed with the question period.